I guess you've heard this before, the global alternate assets at an all-time high, $7.2 trillion. Alternatives in terms of 12% of assets, 30% of revenues, going up to 40% of revenues. The important point here is in this 40% of revenues, or even 30% of revenues, which is out here today, does not include the element of carry. If you include that element of carry, you could potentially argue, depending upon what carry comes through, that you could be half in terms of the industry revenue, which would be very, very significant, especially for an industry which is accounts for just about 12 to 15% of the overall revenue. So that gives you a sense of the revenue potential, and that's interesting for all of us. Okay? Over the next 5 years, one of the largest opportunities which we need to know, we spoke about the industry being fragmented with a scope for a lot of industry, a lot of new players coming up, scope for new strategies and so on and so forth, right? And we spoke about the convergence of alternate and traditional assets, and we believe that we would see a lot more of that going forward. Okay? Some numbers out here. This is just putting it in graphical form. I'm not sure if this is visible. I hope it is. But this really talks about the growth and says that as against about traditional asset growth of 5.5%, you had alternate asset growing by over 10.5 to 11%. So that's a significantly higher growth out there. Growth across, it's very well diversified. It's growth across typically hedge funds, real assets, which is primarily real estate, as well as private equity. The fastest growing have been hedge funds and real estate. Importantly, as you can also see, retail alternatives have been among the fastest growing category, something which the previous speakers also alluded to over the last some time. So fair amount of growth all across the spectrum. Okay. Sorry, this really is the where it stands in terms of global profitability. And as you can see from the global profitability out here, you're talking about 30% today, moved up to 40%, while as a percentage share of assets, we are a lot lower. So clearly a lot of it, and as this mentions, very importantly to all of us, is that this excludes carried interest, and as and when you throw in carried interest, that's a very significant profit pool. Okay. Another one is the fragmented opportunity. I think the speakers earlier also spoke about that, but that's out there graphically, and you can actually see out there that as you go further down, that's hedge funds. The top 5 hedge funds account for only 8% of the overall market. With private equity, it's 9, real estate 16. So very small compared to the other end of the spectrum, where you see in terms of the conventional listed equity and conventional corporate debt, which is over 50% in terms of assets. So very diverse, a lot of opportunity for all participants, right? Few of the things which I thought it might be useful to highlight on is what are the criteria which let us say, which investors look for when buying into such funds. So clearly, it is investment strategy, consistency of returns, risk management, investment team, fund terms, which is fees, especially institutional investors. They're very particular about fees these days, and co-investment opportunities. So this is typically what investment managers have been judged on globally, and I'm sure we can all see that domestically too, in some shape, size, form, most of these criteria are used for judging our domestic managers too, right? In terms of the smaller investment managers, i.e. boutiques, people are seeking them out for unique capabilities, and in terms of the larger houses, people are seeking them more out for stability and width of product offering, and it's a stability and width of product offering which is out there. Okay. Why have people chosen alternate assets? And I'm sure, again, something covered by our previous speakers, which is, a lot of this came out of what happened in the previous bull run. And when you had the great financial crisis, people were seeking a lot more of absolute returns, which alternate assets offered. As you were aware that, most conventional strategies, that is long only equity, etc., did not do particularly well all over the globe for an extended period of time. Hence, a lot of strategies like this went there. Earlier, most investors, when they look at Alternate strategies were looking for what McKinsey described as high-octane performance, but that's moved clearly into more consistent, uncorrelated, risk-adjusted returns, which is what most people are looking for. So caused by the global financial crisis and a period of volatility, which now seems to be ending. I guess with that, I have more or less covered what I want to put on the international perspective, but I think what we need to leave with you is out here is just the following. This is a large opportunity. This has been the hottest growing or the fastest growing asset class. It is extremely meaningful. In terms of the current size of 7.2 trillion, just for a sense of context, that's 40 times the domestic mutual fund size, right? That's the alternate asset space as of today, not what's going to happen out there in the future. And in terms of a profit pool, if you, know numbers on that, or at least I have no numbers on that, if you throw in carried interest, you are probably already, somewhere, or you will be somewhere close to half of the industry revenues. That's very, very important to all of us. Now, what do I mean by alpha opportunity out here? I'm not getting into the technical definitions of alpha. All I'm putting out here is that the opportunity it provides to three groups of people. One is investors, because that's for who we will live and die, so we need to deliver to our investors. Number two, the investment managers, which is guys like ourselves, what we need to deliver. And then finally, the entire industry which is built around it, which is our distribution partners, etc. And there's a very, very sizable pie, as we can see, for all of us. Right? Moving on to a domestic perspective, honest, I'm not sure most of it is visible to you because it's very hazy to me out here. So, but I guess the few key points which I'm making out here are the following. This is a study which has been done by Schroders, and it just talks about how optimistic Indians have been, and it lays down different asset classes which Indians are very positive on. So, most of it which is fairly obvious to you in case you can't see it, which is listed equity is up there in terms of preference, and people are very bullish on that. But what it also tells you, and if you can read some of that fine print, is that Indian investors are increasingly showing an appetite for, property funds, real estate assets, or real assets. In fact, if you club that up, that's close to 30% of investors say they are seeking to invest in such assets, and despite this being in a raging bull market. You similarly have others who are looking for commodities, multi-asset funds, high-yield debt, and so on and so forth. I think the important message is that there is, as we've seen, and we will see with numbers going ahead, that there is enough of appetite for alternate assets, or let's say non-traditional assets. So a lot of it is out there. This, of course, is in the financial form. I am excluding anything which might be in the physical form, because real estate in the physical form has always been there and formed a very large part of most investors' assets, as has real estate. Sorry, as has gold. So moving on, just very briefly, we touched upon the SEBI regulations, and to our mind, the regulations are extremely progressive, extremely forward-looking. I think Sandeep spoke about that earlier. It affords a lot of scope for investors to actually create a range of assets across it. So it's very, very good. In our view, the 1 crore ticket size is just right. Going anything below that may be inappropriate in terms of what investors you're trying to attract. We are also talking about ensuring enough skin in the game, something which is a trend globally and a lot of investors seek and should draw comfort from. Additionally, that was of course in 2012 May when the regulations were first enforced. But when you look at what happened over the last 1 year too, and what we've got out there is a lot of points which what SEBI has subsequently added on, which is again very, very positive. It's stuff on disclosure on the history of any disciplinary history. There was also about reporting, which has been vastly improved. How would the fee structure be? All of those things have been, you've got to put tabulated examples in. Key changes in terms of how you have to account for changes on your, if I was to put this, changes in your PPM and so on, and how you need to go to investors and so on. Introduction of angel investor guidelines and so on. So all in all, very positive, sounds very, very good, and has set the appropriate framework for the growth of the industry. Okay, some numbers covered earlier, but I just want to make a few points from this. This is the growth of the AIF industry. So we know it's about 17,500 crores, and we know that in commitment, in terms of commitment, and in terms of drawdown, it's a little over 6,000 crores. What I would take away from here is that, so when you look at growth of commitment, it's about over 350%. Drawdowns is about 300, and investments is about 400%. It's all very, very impressive. Albeit on a small base, but all very, very impressive. But the important thing, and I think this is very, very important, and a lot of this will determine the future of the industry, is that, see, we believe very strongly that there are only two liquid asset classes in the country. The first one is listed equity, and in listed equity to more of the nifty stocks. Once you go below that, there's limited liquidity. And two is your government security market. Other than that, in most asset classes, supply drives demand. And that's the point which I'm going to try to bring out here. I.e., you've got wonderful commitments, right? $3 billion. But as someone pointed out, you've been able to deploy $1 billion only. I understand that these commitments are meant to be raised over a period of time. But this is one of the key challenges to the industry, the ability to deploy money. See, it's one thing raising it, it's the other thing deploying it, and it's a third thing returning that with good returns. And this, to our mind, is one absolutely of the key challenges. And drawdowns and investment remain a challenge. I bet some of the funds might not be in a position to draw down their entire commitment too within their timeline, and they might need extensions. But I think suffice to say that how well the industry does on this factor, which is the ability to raise, the ability to actually go out and deploy that money, and how successfully they are able to deploy it and get it back, will determine how well this industry grows. And this, to our mind, is very, very key. And as we've seen, somebody pointed out about real estate funds earlier, haven't had the best track record in returning money, etc. If you can deliver, if we can return money to investors, I am sure there are truckloads of money waiting out there to be deployed. But this is very, very important. Okay. Again, a lot of numbers out there, or those bar charts. I think what I just wanted to leave with you is the following. Category 1 collected 39% of the commitment. But when you look at the drawdown number, that's very, very low in terms of what's happened in Category 1. They've hardly been able to get anything invested. So that's clearly a pickup from the earlier point too, that deployment is a big challenge. It's not just about getting those big commitment numbers raised out there. Category 2 appears to be the bulwark, or the bulk of what the money is coming in, primarily dominated by real estate funds, not too much to our mind in terms of private equity, primarily real estate funds and primarily debt. There was this discussion about debt and equity, and I'll come to that later, but to our mind, it's primarily debt. In fact, it's not just Category 2, it's almost all across is debt, and that's clearly been dominating. But that's also been the flavor across all asset classes till about a year ago globally too. So it's equity which has been more popular just in the last some time. And Category 3, to my mind, that's probably the section, or probably the category which will see the most action, or should see the most action. We saw, in terms of global trends, the hedge funds are the largest category globally. We've seen a small start, a promising start, but many, many challenges. Those points were touched upon earlier, I think by Sandeep very, very well. A lot has to do with what's on taxation. Why would anyone come to an AIF fund if he's going to pay MMR, right? Doesn't make too much sense. When you can do equity in different ways, you might as well do it through PMS too, if you have to, assuming you can. The cost of leverage, 3, we are in such a bull market that, unless you're talking about 2x, 3x returns, in terms of people are going to be less inclined to move anything from a long equity fund. So a lot of constraints which are coming in the way, but assuming we get tax, this industry gets tax pass-through status in this budget, as is widely expected in a lot of quarters. We have no insight. This is what we hear, and it's widely expected. If that indeed happens, then I think that should be a very, very big booster for Category 3 funds, and they should see a lot of action out there, right? Moving on, a few other key observations, most of which in some way have been covered, but just again to highlight the key points. The first one is that it is a domestic HNI market. There is almost negligible institutional presence across any category. And one of the reasons for that is, again, taxation. When you're looking at taxation into a lot of, let's say, the insurance companies, etc., the current regime and the current structures are not, let us say, conducive for such institutional investors to come. As a separate thing, You don't have too much of institutional investor participation in general in most markets, or at least in India, in the alternate market. So that's one. You've seen, in terms of who you've seen launch, you've seen a blend of boutiques. You've seen a lot of boutiques of the over 120 names, and you've seen a lot of the large fund managers too. So you've already seen that, both playing their game, both having their respective focus. Wide range of strategies. I've not got into all of it, but when you look at it, you've got a film fund, you've got a gems and jewelry fund, you've got so many funds when you look at the spectrum. So that's very, very encouraging. You've got a huge spectrum, a huge opportunity all across its four. We mentioned about boutiques. The other point which I think we must highlight is that it's got wide acceptance. AIFs have got wide acceptance from investors. Investors, to my mind, have taken to it very, very readily, and also from wealth managers, because even when I look around me, I see a lot of colleagues from a wealth management industry out here, and there's been most wealth management organizations have been very active in selling this product, which shows wide acceptance. I was just doing some back of the envelope calculations. You may use your own numbers, you can do whatever, make your own assumptions, but I suspect that you probably have 5,000 to 7,000 investors who have come into the space. You can do your own math, work backwards. All you need to do is to take an average ticket size and try to work out what sort of investors have come. And I suspect that you've got 5,000 to 7,000 sort of investors who have come into this industry over the last 2 years, which at a 1 crore ticket size is fairly encouraging, right? So it's a fairly good start. Investors have taken it well, wealth managers have taken it well. Okay. Cost of regulatory compliance, which is a very big issue, especially globally, has been, to our mind, very manageable here, which encourages a lot of boutiques to continue to mushroom, flower, and prosper. And it's a great, great opportunity for anyone with entrepreneurial skills. You have a great idea, you have good backers, well, you can go out and do it. So there's going to be a lot more we see in terms of boutiques, as you've seen overseas. I'm sure we'll see that here. So those are a few of the key trends. We've seen that play out, and we believe we'll continue to see it going forward. Okay, now I put some numbers out there. This is just my assumptions. You can put your own numbers, you can disagree with this, but what we've just tried to put out there is, what does the P&L of the industry look like, right? We talk about profitability, we talk about growth. You may argue that it could be different, it could be higher, it could be lower. All of this is assumption. I've just put it on the table. I'd be happy to invite comments from anyone. So we've just taken some, what would be the, let's say, the revenue numbers, what would be the costs involved. In costs involved, one of the larger costs is, of course, our distribution income, other than all the other aspects. And then what's the net retention for investment managers? And the expense for the AIF industry is the income for someone else, right? So we put it all out there, and depends on how you want to see it. I've taken it on about 6,600 crores, which is the amount which is drawn down, or you take it on the entire commitment. That choice is yours. You could do it. We've done it on both. And what we put out there, we made some assumptions on variable fees. We made some assumptions on what could be the, the potential returns in terms of, let's put it, carry. You could, again, we've just said that we're taking a 1.5% management fee on the drawn down amount. We've taken that 50% of the money comes in for structures with carry, because there's a lot of debt, especially in the earlier category, which may not be there. We've taken an average performance, a hurdle rate. You can put your own numbers in. I can share this with any of you who might want it. Okay? And what we come out with is that you could potentially, on an asset size of, on a commitment side of about 17,500 crores, with some of these assumptions, you could have an entire industry, let us say, a top line or a revenue of over 1,000 crores, 1,100, okay, and a fair amount of money off that. You could say 40% would go in for distribution commissions, another 10% for other expenses, and a lot of potential revenue opportunity for AIF investment managers. This is just food for thought. I'm not by any means suggesting this is precise, or this is what the numbers would be. Take your pick, but just some numbers. And all I would leave with you is that, as you can all see, this can be fairly material for all of us, right? Okay. Now, just so what do we need to make this work? Clearly, we have to deliver on the commitments which we have made to our investors, because investors have trusted us with money. They've given us this, well, 17,500 crores. You've got to draw it down, you've got to deliver on it, and you've got to return it to investors. You've got to do all of that, and if you do that, I am sure there's a lot of money out there. So it's investment in investment management capabilities. A lot of investment managers, the first timers, not too much experience, so we've got to deliver on that, else you will have bad experiences, bad blood. And bear in mind, as was spoken about earlier, this is not a business you advertise for, right? This is private placement. It's word of mouth. So bad press, bad word of mouth will not get you very far. So you've got to clearly deliver. And in the category which we are talking about, 1 crore and above, only one thing counts, performance. If you can deliver on performance and reasonable client service, you will have all the money in the world, else you won't. So that's the most important thing which you need to deliver on. Human capital, which is again, all related to it. In terms of new products and strategies, I think this was touched upon too. You've got to come out with something which is innovative, because most of what we've seen innovation, we've seen a lot of interesting things, but wherein there are some taxation changes, and on the other part I don't think we can do anything about, which is in case leverage becomes cheaper or more affordable, there's a lot more scope, especially in category 3, not in category 1 and 2, which could potentially offer itself for, for exploration and so on. But those are a few of the interesting things you should do. So new products and strategies, we've seen guys do good things, and we hope to see more of that. Client communication and transparency, a lot of it has been a black box-ish, but hopefully guys the entire industry is moving to a greater degree of transparency, more accountability, and that should help. And finally, investment in infrastructure. To a lot of organizations in the AIF space, they're typically very, I would say, thinly staffed. Maybe one needs to invest a lot more in team, in infrastructure, in investments, which should hopefully see a lot more, right? So, and preferably avoid competing with the traditional assets, because if you're competing in a category 3 fund, if you're going to compete with a mutual fund which has certain tax benefits, it's not going to get you very far, because clearly it is there's a lot more benefits which is out there. Okay, good. These are not exactly mine. I may have modified these words a bit, but this is from a McKinsey study which was quoted earlier, and it talks about the 6 critical aspects which to succeed in the AIF space, what one needs to do. Most of it is fairly obvious and relevant for the Indian market too. The right aspirations means the right target audience, the right objective. So you've got to have the right objective. You've got to have aspirations which meet that objective. So that's what it really means. Investors' expectation is focusing on your target segment, because you can't be all things to everybody. That's not what the AIF space offers itself to. It's a lot of small niches. You've got to decide what your niche is, or what your few spaces are, and how you're going to go after that, how you're going to go after those investors, how you're going to meet their investment expectations, right? Understanding the business economics, which primarily comes to in terms of working out your cost structure, what is the fees you hope to charge, how do you work that maths out, what is the infrastructure you want to put in, so stuff like that. So because you are a lot of the earnings will also come for different managers at the back end, which is in terms of performance-linked fee. So how you make your economics work till then, right? A clear product strategy with definite outcomes, which again comes to a focus on appropriate investment management, let us call it delivery and technology out there. Distribution, which is very, very key to this model. And finally, robust governance, which is what people look at in a relatively, or people look more at in a relatively illiquid asset class. Finally, just a few things out here to conclude, and I'll be happy to take any questions after that, is that I think we've had a wonderful start. There is an alpha opportunity, and again, I'm defining alpha as an opportunity which is out here for us to deliver for our investors, for our distribution partners to make this a vital part of their clients' portfolios, and 3, for ourselves as managers to earn, let's say, reasonable returns, or I would like to say fairly handsome profits. Okay. 2 is response from the industry has been very encouraging. I told you about how it's grown. Importantly now, a lot needs to be put in place, especially in terms of delivering on the I use the word here, commitment. There's no commitment, but what our investors have sought us for, which is delivering on the investment management performance. And we have a few challenges, of course. Hopefully some of those may get sorted out. I don't think this is this may be the forum to talk about other changes which may be required in terms of taxation and so on. But if we do have some, as is widely believed, which would happen in the budget which comes about, and this is industry expectation, that should be very, very good news for all industry participants, more so in category 3. Okay? With that, I just conclude that we have the platform. We've been provided with a wonderful platform. The onus is on all of us now to deliver on that, right? With that, I just rest my case. I'd be happy to take any questions which you may have. Yeah? Sorry.
Do you look at there's a small companies listing available on the BSE and NSE. How would you compare them vis-a-vis small caps per se?
Okay, you are talking about buying, sorry, are you referring to buying a small cap directly on the BSE?
No, what I'm saying is there are companies which are listed under the small SME.
Correct, correct. Yes.
Now, are we seeing that kind of a concept coming under the AIF mold as a product per se, or BSE, NSE, and how good are these concepts to look at?
See, it could come in from the following perspective that, anyone who looks at maybe a pipe fund,
Okay.
right, which is, taking large stakes in sort of smaller, high growth listed companies,
Sure.
could participate in that. Okay. It could, or you could have a private equity company who might choose to list his company there. So there could be, there could be interest from that perspective. It's possible.
But is it an attractive opportunity?
That would depend on the underlying, let us say, underlying investment merit of that particular opportunity, which unless one knows that, it might be difficult to say.
Shahzad?
Haji.
My name is Chandru. I'm from MSCI.
Haji.
Clearly, there seems to be a lot of potential for AIFs,
Right.
but there also seem to be a lot of systemic issues,
Right.
which is very typical of a growing industry. So I just wanted to know, is there a formation of a self-regulatory mechanism or a body similar to AMFI to take up all these issues, whether it be on taxations or putting in place best practices, which would in turn enhance the credibility of the industry and attract more investors?
See, there are bodies which is like the Venture Capital Association or the Venture Fund Association of India. There is another body which Aditya was working on. Okay, but I guess one of the things which is as different from maybe the mutual fund industry, which has AMFI as a body, which is a very progressive and a very powerful body putting forward the industry's view, is that the mutual fund industry might be a far more, or not might be, is a far more concentrated industry, far more regulated in that sense, so there are fewer players, easy to come by. When you look at the AIF industry or the VC industry, there are, there are a lot of people out there, so all coming together. But I think the point which you are probably getting at, which is that there is an acute need for a body which puts forth the industry view, because there's no point in raving and ranting if you can't get your view across to the appropriate bodies and authorities to take remedial action. I think there is merit in doing more work on that front.
Hello.
Yep.
Yeah, I'm Vineet here. I just wanted to understand all this 17,000 crores that has been raised in the AIF so far. Has it been primarily driven by funds that have delivered track record in the last 5-7 years, or people have taken bets on new teams as well?
Okay, I think there's been less of the former, what you said, which is of there are a lot of first-time funds who have got very good money, who have collected very good money. There are, in fact, I would imagine that probably more money has gone to relatively newer funds. It's the way it was distributed, and then again, to my mind, it's this aspect of supply. Very often, if you can, let's say at some point in time, if even my child who's in school went and sold a real estate fund, maybe 18 months ago it might have sold, just because there was so much of appetite for it. That might not be the case today. That might not be the case. So it's just also right place, right time, and so on. But to answer your question, sir, I don't think that it's been so much, because to be fair, that's another thing which, and it also ties in with the question this gentleman raised. I don't even think at this point in time there are too many. There are, of course, SEBI has now introduced standards of performance, let us say, documentation, measuring, and capturing. But to put it together, like say in an MF industry, you'd pile it all together and you can just compare who's done what in which category. I don't think we're there yet, but sorry, the short answer to your question is, I don't think that's led primarily fundraising.
Oh, thank you.
Yeah? Any questions? Fine, with that, I just say thank you. All this was meant to be was food for thought, and I'm not saying that by any means these are the right views, but just points for debate. Thank you for your time and attention, and have a good day.
Thank you, Mr. Madon. I would quickly request Mr. Aditya Gadge to kindly step onto the dais and felicitate Mr. Madon.